We're looking at a market that seems to be pricing in more and more Fed rate cuts. We're thinking about maybe 3, pricing in 2, of course, thinking about maybe we'll get to pricing in 3. And that's pushing futures higher, a bit here in Europe and also in the United States. How will the market deal with some sort of shadow Fed chair situation? Is that what we're looking at here?
Well, first of all, we're already seeing the impact in terms of a softer dollar. We're seeing slightly softer yields. I don't think the overnight story, it was an incremental improvement on something we've known has been kind of vulnerable for some time. I think Bloomberg had a story a couple of weeks ago saying that Trump would announce a successor early as a way of undermining Powell. So now you've got some more names in the frame. It's kind of reaffirming that idea. So it's been out there for some time. It's a marginal driver, weaker dollar. But the dollar downtrend has been firmly entrenched for some time. So really, it's pushing through an open door there in that trade. I think the yield story has probably gone far enough given the risks coming up. So I'm not sure yields go much lower from here, but I do think dollar continues to go down.
Mark, does that mean we end up in a situation where if you're a US investor and you invest at home, then you're probably going to make 6-7% this year, maybe a little bit more, but you're going to lose a lot of money if you're a non-US investor? Can we have a simultaneous situation where the US market looks great for America, but terrible for the rest of the world?
I think yes. Once you factor in FX, I think US stock markets will continue to perform over the next coming years. I don't think it's hard to have such conviction and such views over a couple of month basis because I think tactical factors drive that relative performance over a short-term basis. Relative performance trades work much better over a longer-term horizon. In the same way that US stocks have outperformed for the last 14 years, I think they'll have many years of underperformance. A large part of that underperformance will come through the FX exposure. It doesn't matter where you're based in terms of that if you're a US investor, if you're going to buy US stocks or you're going to buy other stocks around the world unhedged, you're going to make enough on the currency side that it doesn't even matter if your stocks don't underperform. But I think the stocks could also outperform given that they're cheaper. And obviously for investors in the rest of the world, it's much worse buying US stocks now. And that's why we're seeing a change in dynamic. But this is a real structural story. This is why I think we had 14 years of US stocks outperformance. So it's going to take many, many years for those flows to come out. This is not something you trade over a few weeks or even a few months. It's a multi-year horizon.
Mark, how long can the dollar and bond yields trade in different directions? How long before that snaps back?
I mean, in the very short term, they're not trading in massively different directions, but I know what you're getting at, Kriti. There's been a widening differential with the US to the rest of the world. I think that can last for some time, and I think actually it may get worse for a brief period this year. Longer term, of course, that there'll be a little bit of a reconnection of that story. But the problem is the moment we're really worried, and it's increasing, slowly increasing and steadily increasing concern about the US fiscal situation, US debt situation. And people are very worried how that ends. It doesn't seem like it's going to end with an ameliorating debt situation for the US. It seems instead it's going to end with some kind of crisis, might be a dramatic word, but a bit of a scare in the debt market. Until we go through that process and we get a better situation, I expect yields in dollar to continue to diverge.